Welcome back to The Explainer. Today, we're breaking down a massive economic headline that is currently echoing through the markets, government halls, and honestly, most importantly, our own bank accounts. The Bank of England just made its latest call on interest rates, and the ripples from this one single decision are being felt everywhere, from global energy markets right down to your monthly mortgage and electricity bills. We are going to totally demystify what this rate freeze actually means, decode the massive global forces driving it, and map out exactly how it lands right on your doorstep.
Okay, let's jump right in. 3.75%. That is arguably the single most important number dictating the UK economy at this very moment. This is the Bank of England's base rate. It's basically the interest rate the bank charges other banks and building societies to borrow money, which then sets the baseline for what you and I pay on loans and what we earn on savings. And for the fourth meeting in a row, the Monetary Policy Committee has decided to hit the pause button. They're holding this rate exactly where it is at 3.75%. But listen, a freeze on the base rate absolutely does not mean the economy is standing still. Far from it.
So to figure out what this means for you, here is our roadmap for today's explainer. First, the big freeze. Second, global shockwaves. Third, a UK economy snapshot. And finally, the impact on your wallet.
All right, Section 1, the big freeze, holding steady at 3.75%.
You know, what's really fascinating here is the internal drama this decision reveals. Because holding rates at 3.75%, it was not unanimous. The committee voted 7-2 in favor of the freeze. And those two dissenting voices, that was the bank's chief economist, Huw Pill, and Megan Greene. Both of them actually voted to hike the rate up to 4%. Why? Well, they're deeply concerned about all this ongoing uncertainty surrounding higher energy prices for households and businesses. They looked at the data and basically argued that the economy needed a firmer hand right now to keep inflation from running away.
Bank Governor Andrew Bailey actually hit the nail on the head with this quote. He pointed out that while recent drops in oil prices are definitely encouraging, the high energy prices we've seen during recent geopolitical conflicts have already created a backlog. Notice that phrase he uses, in the pipeline. That's such a crucial metaphor. It means the high cost that businesses paid for energy over the last few months, they haven't even fully reached us consumers yet. That past inflation is literally still traveling down the pipes, getting ready to pour out into our domestic bills. So the bank's main job right now is to ensure this pipeline pressure doesn't turn into sustained long-term inflation above their 2% target.
Moving on to Section 2, global shockwaves, the Middle East, and oil.
We really can't understand our domestic interest rates without zooming out to look at the massive geopolitical gears turning behind the scenes. And that brings us to a critical choke point, the Strait of Hormuz. This one waterway normally handles a massive 20%, that's a whole fifth of the world's oil and gas supplies. Recently, policymakers noted that oil prices were staying higher than before the Iran conflict and just generally continuing to be really volatile. But the committee actually met just before a major US-Iran peace deal was signed. If this new deal actually leads to reopening the strait and letting oil flow freely again, it could significantly ease the exact inflation fears the bank is so worried about right now.
Look at how incredibly fast things shift over just a few months. In March, the conflict kicks off, sending these massive shockwaves through the energy market. By the bank's April meeting, they were expecting high inflation, bracing for impact with an 8-1 vote to hold rates. But jump forward to June. With that US-Iran peace deal signed, the bank actually lowered its overall inflation expectations. They're now projecting inflation to hit 3.25% in the final 3 months of the year. Now, 3.25% is for sure still above their 2% target, but it is noticeably lower than what they were bracing for just a couple of months ago.
Which brings us to Section 3, a UK economy snapshot and how we compare. With all those global shockwaves in mind, you might be wondering, is there one obvious right answer to managing these economic pressures? Well, looking at the global stage proves there definitely isn't. Central banks are taking entirely different paths. While the Bank of England and the US Federal Reserve have both opted to hold their rates steady, even with deep internal divisions, mind you, the European Central Bank took a totally different route. Just last week, the ECB opted to increase its interest rate for the first time in almost 3 years, specifically calling out global conflict for generating inflation pressures. It's wild. Everyone is looking at the exact same global energy shock, but reacting in completely different ways.
And this just brilliantly illustrates why there is no easy fix here. The UK's domestic data is flashing some incredibly mixed signals right now. On one hand, overall inflation held steady at 2.8% in the year to May, and the pace of food price hikes actually slowed down to a 17-month low. Increases on things like meat, dairy, and veggies are easing up, which is great news. Plus, the job market is cooling off. Job vacancies just hit a 5-year low as firms get a bit more cautious. But on the other hand,
Transport costs are rising at their fastest rate, so it's a total tug-of-war for the Bank of England right now. Cheaper food and a cooling job market pulling inflation down, while transport costs yank it right back up.
Finally, Section 4, the impact on your wallet, mortgages and energy.
So how do all these macro global trends actually arrive at your front door? Well, even though the Bank of England held the base rate steady, the reality for anyone trying to borrow money right now is undeniably painful. Mortgage rates have taken a stark jump since the conflict started in early March. An average new 2-year fixed deal, that's jumped from 4.83% all the way up to 5.59%. 5-year deals have similarly climbed from 4.95% to 5.57%. Because of all this global volatility and uncertainty about the future, banks are just pricing in the risk. That means your cost to buy a home or remortgage has gone up significantly over the last few months, completely regardless of the official base rate freeze.
And then, of course, there are your household utility bills. Remember Andrew Bailey's warning earlier about inflationary pressures still being in the pipeline? Well, this 13% is exactly what's coming out the other end of that pipe. Because of the delayed impact of those higher wholesale energy prices from earlier in the year, Ofgem, the UK energy regulator, is jacking up the price cap. This means millions of households are going to face a 13% increase in their energy bills this coming July. Those global oil spikes from the spring, they are directly becoming the painful utility bills of the summer.
So where does that leave us looking ahead? The Monetary Policy Committee meets again at the end of July. By then, we should have a much clearer picture of whether that U.S.-Iran peace deal is holding up and if oil is freely flowing through the Strait of Hormuz again. But with inflation still projected to hover above that 2% target and our household energy bills jumping by 13%, we really have to ask, is this rate freeze just a temporary pause for them to assess the data, or is it literally just the calm before another economic storm forces the bank's hand? Thanks so much for joining me for this explainer, and definitely keep a close eye on those July numbers.